Hello everyone and welcome back to another Stock Unlock video. In today's video, we're going to be going over Zoom. This is a stock that is down like 85% year to date, and a lot of people over on my main channel have been asking me about Zoom. Is it a buy right now? Is it looking cheap? And really, what are my thoughts on Zoom? So today on the Stock Unlock channel, we're going to be quickly analyzing Zoom, and I'm going to let you guys know exactly what I think about the stock and basically how I came to that conclusion. With that being said, let's just hop right into the video. Right here, we can see that on our stock chart, back in 2019, Zoom was about a $70 stock, okay? Then the stock ran all the way up to about $560. It was literally up about 710% over just the course of a year. It actually got up to about 750% gains from the bottom in 2019 to the peak in 2020. This was an absolutely insane move. And honestly, well, this was obviously because Zoom was a company that really benefited from the lockdowns and from COVID. People still had to work and people wanted to communicate with each other, and they did so over Zoom. So Zoom was one of the stocks that really benefited from COVID, and it was like a COVID darling. Now we can see that Zoom is down about 85% from its peak, down to where it is trading now at about $81 to $85. We can also see that over the past month, the stock dropped. And again, this is because Zoom just recently reported their second quarter earnings. The earnings were not as great as everyone was expecting, and that led to the stock falling about 16% just after the earnings alone. Basically, just the bottom line of this video, I'll give you guys my thoughts on Zoom right away. I don't think that this company has a moat. Here on Stock Unlock, we run all of our online meetings and everything through Google Meets. It's free. We don't have to pay anything for it. It works really well. And we've never really felt compelled to use Zoom. So for me, I don't know why I would ever go and pay for Zoom personally. And that's why I just don't really think that there's a moat, because I think that there are a lot of free options out there. And when you're trying to save money, you're going to use a free option, which is exactly what I do. If you know me from my Daniel Pronk channel, I'm quite a cheap guy. I really like to save money. Also, Zoom's revenue growth is really starting to slow down. If we head over to their financials right here and we take a look at the quarterly revenue, we can see that really over the past about 5 quarters, the revenue hasn't really grown that much. Back in the second quarter of 2021, it was about 1.02 billion, and now it's about 1.1 billion. And in terms of percent growth over the past 5 quarters, that's like not even 10% growth. And Zoom was supposed to be this super high growth company, right? So to me, it really looks like the growth for this business is slowing down. Let's go and take a look at our Stock Unlock insights for this business, because our insight score is quite high actually. It's a 4.25 out of 5, which means that this business does have quite strong scores here on Stock Unlock. We can see that the profitability score is a 4.4 out of 5. The company has very high gross margins at 75%. That's actually really good. The operating margin is about 20%, which is average, but the net margin and the free cash flow margin are quite high and they are very good. The cash conversion is also above 100%, so that is very good. That means that over 100%, or essentially all of the company's earnings, are actual cash flow for the business. So they're all cash earnings, which is very good to see. If we take a look at the company's financial health as well, it's sitting at a 4.8 out of 5, which is almost as good as it can get. The current ratio is above 3. That is very good. The company is debt-free, which is very good. It has low intangible assets as a percent of its total assets, which is very good as well. The shares have decreased over the past year, so the company is buying back shares, and they have more cash than total liabilities. So this company is very cash rich. So in terms of the company's balance sheet and its financial health, very good. Again, it's 4.8 out of 5. And that is very strong. Now, the company's growth score is 3.4 out of 5. And this is okay. It's decent. It's not amazing. So let's take a look at this. The revenue, the trailing 12 months revenue over the past year grew by about 18%. Net income is decreasing, however. Free cash flow is decreasing. Book value and tangible book value are increasing, however. So it looks like the company's revenue is still growing, but it looks like the net income and the free cash flow are going down, which is harming the growth score here, and it's only a 3.4. So what I'm seeing for Zoom is a company where the revenue is still growing. Net income and free cash flow are going down, however, and the financial health is very good, and the company's profitability is also quite strong with those pretty high margins. So now once again, let's just go over to Zoom's financial statement here. And we already saw that the revenue growth is really starting to slow down. So let's take a look at the company's other metrics here. Let's take a look at the gross profit. This is the exact same story. So the company's gross profit is kind of just leveling off. It's kind of just, staying with whatever the revenue is doing, which also suggests to us that the company's gross margin is remaining intact, which is actually quite good to see. If we go down to the company's operating expenses, we can see that the company's operating expenses are continuing to go up. They're continuing to increase. This is not a great thing to see because think about it. Zoom's revenue growth is basically leveling off. It's essentially flat, but the operating expenses or the expenses to run the company are going up, and they're going up quite dramatically. This ultimately means that the company's operating margin is going down, and it also means that the company's operating income is going down because, again, think about it. You got flat revenue, but you have increased operating expenses, which obviously means operating income is going to go down. And it's going down in a pretty big way as well. I do not like to see this personally. And we can mostly see right here that the operating expenses increasing is coming from the selling, general, and administrative expenses. So I went over to Zoom's 10Q and I took a look at the company's operating expenses. And right here, we can see that the operating expenses are really growing from sales and marketing. In the first 6 months of the year, this year they were about $763 million, okay? Last year they were about $517 million. So the sales and marketing expenses have increased by about $250 million so far this year, but the revenue has only grown by about $200 million year over year. So they put in an extra $250 million into sales and marketing, and for that, they got $200 million of revenue growth, which ultimately means that Zoom is putting in more money to sales and marketing than they're getting out in revenue growth, which means that their return on their investment in marketing is really starting to slow down, and it's not being nearly as effective or efficient as it has been in the past. So essentially what this means is that the company is having to spend a lot more money to try and grow revenue. And it's getting to a point where it's not really doing it anymore. And they're actually starting to generate a loss on this, in my opinion. We can also see that if we head over to the company's metrics and we take a look at the return on invested capital, it is going down over time. And in the most recent quarter, it was only about 1.53%. This is exactly what we were seeing on the income statement, with the operating income going down and the operating expenses increasing massively. And those increased operating expenses are not really leading to any revenue growth, very, very slight amounts of revenue growth. This is not a trend that I personally like to see. And also, I went over to Zoom's cash flow statement, and we can see right here that the stock-based compensation expense this year was about $465 million, okay? That is a lot of stock-based compensation, especially when we factor in that the company's revenue isn't really growing. This is insiders essentially diluting shareholders to pay themselves, and it was the amount of $465 million. That's a lot. Last year, it was $201 million. So stock-based compensation has more than doubled year over year so far in 2021. What's also interesting is the bottom line here. The net cash provided by operating activities went down by about $228 million so far this year. So the company is not producing as much operating cash flow this year, but the insiders are paying themselves more than double, and it's $465 million, which is also more than half of the company's operating cash flow. So it looks like the insiders are paying themselves a lot, while the business's fundamentals are, in my opinion, actually declining, which I don't like to see as an investor, just myself. So let's head over to the company's cash flow statement here really quickly. And we can see once again that the operating cash flow is coming down. If we hit the trailing 12 months, we can see more clearly that the operating cash flow is coming down. If we also take a look at the free cash flow, this is the same story. The company's free cash flow is starting to come down as well. Basically, what I'm seeing is just, this company's margins are starting to go down. Let's actually head back over to the metrics. We can see that the net margin is really starting to come down recently over the past couple of quarters. The operating margin has been coming down for several quarters. And if we take a look at the free cash flow margin, the free cash flow margin has been declining and trending down for several quarters as well. So this business's profitability is ultimately coming down. The ROIC is coming down, and the revenue looks like it is starting to struggle growing. Now, what's also interesting is if we head over to the insider information here on Stock Unlock, we can see that insiders are selling their shares very quickly. And if we just scroll down, all we can really see is insiders either exercising their shares for $0 or selling their shares. We can see that, for example, right here, the CFO has been selling literally every share they have, and then they exercise shares, and then there's more insider selling. So this is kind of the trend that I am seeing here, and this is a lot of insider selling. Just back a couple of months, you guys. This isn't even that far back. And what I'm seeing is no insiders buying. And again, you can see that the insiders are exercising their shares and then basically selling them right away. And yeah, I just don't really like to see that. So the insiders don't seem that bullish on this business as well right now, at least in my own opinion. So basically, Zoom looks like the revenue growth is slowing down. It looks like profitability is slowing down. They're having to spend a lot more money to grow revenue slightly, which is not a good thing. ROIC is going down. Insiders are selling their shares, but the one thing that this business has going for it is it has a very, very strong balance sheet. So I don't know if Zoom is going to turn the ship around, if they're going to see more growth in the future, if they're going to do something about that using the cash on the balance sheet. But ultimately, this company is profitable. It's still generating cash flow, and it does have a strong balance sheet. So I don't think the company is going to go out of business anytime soon. I just personally don't think that it is a fantastic business, in my own opinion. Now, lastly, if we head over to Stock Unlock's freeform tool here, what we can do is we can go and take a look at Zoom's price to free cash flow. Now, let's take a look at how that is doing. And let's take a look at from 2020. Just to let you guys know, Zoom's price to free cash flow back in 2020 was 481. That's insane. That's very, very high. Now the price to free cash flow is sitting at about 20. That's not that expensive, if I'm being honest with you guys. Like, if Zoom could continue growing in the future, I personally think that this could be a decent price to free cash flow, but I just am not confident in Zoom's future growth, especially to its bottom line with the company's expenses increasing. And I mean, if we take a look at the price to operating cash flow, what is it sitting at? About 17.9, right? Now, this is something that I do on my own personal channel, Daniel Pronk, but I like to compare stocks versus Google because I think that Google is like one of the best stocks in the world. And if we take a look at Google's price to operating cash flow, it's below Zoom. And I think, well, personally, I am much more confident in the future of Google. And I think that Google is a much better business. And currently it's selling at a discount to Zoom in terms of operating cash flow. So as an investor, I would have to compare Zoom, a company that I'm not very optimistic about, a company I'm very unsure about, versus a company where personally I am very sure about, and the company that I'm very sure about is cheaper. So personally, I would not be buying Zoom right now. And I do see a lot of red flags with this business. So that's kind of just my thoughts on Zoom using our Stock Unlock platform here. And let me know what you guys think down in the comment section below. Also, if you're interested in gaining access to Stock Unlock, we now have a 14-day free trial, and I'll put that at the top of the description. And you guys can come and get access to this platform. You don't need a credit card or anything. You can come and check out Stock Unlock yourself. You can play around with it, and for 14 days. And then if you don't want to sign up, that's fine. Again, we don't need a credit card or anything. Just come play around and see if you enjoy the platform. It's great, and it's getting better every single day. We actually have a new feature that we're going to be putting out within the next 2 weeks. So if you start your free trial today, you're going to get notified on a new feature that we're releasing. Because as I said, this platform is literally getting better every single day, and it's a great platform. So go and check out Stock Unlock, and let me know what you guys think down in the comment section below. Also, if you enjoyed this video, please remember to leave a like on it. I really appreciate it. And if you want to see more stock market related content like this, then please consider subscribing to our channel as well, because we're going to be putting out a lot more content. But that's going to wrap up the video, everyone. So thank you so much for watching. We truly do appreciate it. And I really hope to see you all again in our next video.